What happens when government bonds breach a 40-year uptrend? This question may seem abstract, but its implications are far-reaching, impacting the economy and the investment landscape in profound ways. Consider the recent trajectory of U.S. government bonds. They've breached a 40-year uptrend, plummeting to levels last witnessed in the year 2003. It's a stark reversal, echoing the severe bear markets of the 80s. This signals the onset of a collapse in the government debt market, with significant repercussions for the economy and investors. Traditionally, Treasury bonds have made up around 40% of investors' portfolios, but recent times have seen them incur substantial losses, with gold outperforming Treasury bonds by an astonishing 170% since March of 2020. This shift in fortunes is a direct consequence of unprecedented government spending. Data from the Bureau of Economic Analysis paints a clear picture of this shift. Government spending has surged from $3.4 trillion to nearly $4 trillion in just 2 short years. It's the fastest rise in spending in over 2 decades, and it has sent alarm bells ringing in financial markets, contributing to the ascendancy of gold over Treasury bonds. When government spending increases, it necessitates greater borrowing through the issuance of bonds. This influx of bonds diminishes their value. In contrast to gold, whose supply cannot be rapidly expanded, the issuance of Treasury bonds is escalating rapidly and is projected to reach a staggering $1.9 trillion by the year 2024. That's surpassing levels seen even during the 2008 financial crisis. The long-term outlook for Treasury bonds suggests a continued decline. The deterioration that began in 2022 likely signals the start of a protracted bear market. The declining labor force participation coupled with escalating government debt underscores a troubling trend. With an aging population and a shrinking workforce, the burden on government finances will only intensify unless mitigated by substantive policy changes. As for gold, despite recent gains, it may encounter resistance. However, the prevailing debt landscape suggests a continued upward trajectory. This offers abundant opportunities for precious metals in the foreseeable future. Treasury bonds may witness short-term volatility driven by fluctuating inflation expectations. However, there are indications of a potential reversal in inflationary pressures, which could bode well for Treasury bond prices in the medium to long term. Uncertainties persist. There's a possibility of a double bottom in Treasury bond prices before a substantial rally ensues. Nevertheless, the overarching trend points towards a prolonged downturn in Treasury bond prices. This necessitates a cautious approach for investors navigating these tumultuous waters. In summary, the breach of a 40-year uptrend in government bonds heralds significant changes for the economy and investors. Increased government spending has led to a devaluation of Treasury bonds and a rise in gold. With the potential for continued economic instability, investors must remain vigilant and adaptable in the face of these evolving financial landscapes.